UiPath shares get obliterated after reporting earnings. We can see the stock is down roughly 34%, sitting at roughly $12 with a market cap of $6.87 billion after reporting earnings. So on today's episode, what I want to do is take a closer look at three main reasons why this stock got hit so badly, maybe some reasons to be bullish as well, and just my overall thoughts on the company. So let's take a closer look in today's episode.
I want to thank The Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for their subscription service. Now, let's continue with today's episode.
So I want to start off with the three reasons why the stock dropped. And reason number one is just overall macroeconomic challenges. During the earnings call, UiPath really mentions that there is this challenging macroeconomic environment that has really impacted their deals from not only smaller and mid-market customers significantly, but also their larger enterprise customers have kind of shown an increased deal in scrutiny and longer sales cycles. So it's taking them a lot longer to make any sales, and especially on those that have those multi-year contracts. So right now, definitely kind of a weak red flag for the SaaS industry one way or another. We definitely saw a lot of other SaaS companies kind of down today. Now, one thing that I did not like during the earnings call, UiPath mentions that, hey, look, they acknowledged that there were some issues with deal execution, including contract execution challenges and changes in sale compensations that may have unintentionally disincentivize large multi-year deals. Now, the company is working to rectify these issues, but they have contributed to the softer guidance for the upcoming quarters. So this is something you definitely don't want to see, right? There have been some issues, some culture changes there in the sales side, and that has dealt with some kind of headwind for their sales team. So to me, if I was an investor, that would be one of my scariest things. Though the company did mention that despite these challenges, sectors like the healthcare, financial services, and the public sector have shown positive returns on investments in AI and automation right now. Now, reason number two is there was a very unusual transition in leadership. The ex-CEO now, Rob Enslin, kind of just departed out of nowhere, and he's no longer gonna be the CEO. For those that are not familiar, the new CEO is actually a co-founder, Daniel Dines. And he, I believe, was the CEO prior to the IPO. And Rob and Daniel both work on building this company together, right? So they've been working together. But it is pretty interesting to see the kind of departure of the CEO. He mentions it was more for personal reasons. And now the new CEO, which was a previous CEO, is gonna take the realm. And obviously, this is gonna create more concerns about stability and potential for short-term disruption, right? Because you're already seeing some weakness with things like that sales, those sales challenges that they had earlier on. But so there's some form of culture problem there. But now you're changing leadership as well. So there's going to be so much changes happening and so much uncertainty. And I do believe that's going to bring even more and more volatility to the stock, and another reason why the stock took a huge hit. So Daniel, he is the co-founder with deep understanding of the company. Obviously, that's very bullish. The transition period could introduce execution risk as the company realigns its strategies and operational focus. So I want to say the leadership change so drastic, plus that weakness in the sales execution because of some of the culture or some of the incentives that they did not provide, in my opinion, are very true reasons why the stock is down. Now, the company did reduce their financial guidance for the upcoming year. For the full fiscal year, revenue is expected to be roughly $1.4 billion to around $1.4 billion, and annual recurring revenue is expected to be $1.6 $6 billion. Now, I just want to take a closer look at how that compared to previous values. And previously, the company mentions that they were expecting for the full year to be annual recurring revenue to be roughly 1.725 billion for that whole year. So we can definitely see that there was a nice pull down, almost a little bit over $100 million here in weakness compared to what they kind of mentioned last quarter. And again, it has to do with all the different things that are impacting the company right now. The company mentions that, hey, look, right now they are taking into account the overall weakness in leadership change and some of the macroeconomics that we're seeing right now as well.
Before we go any further, we are now on the road to 50,000 subscribers by the end of the year. Thank you all for the crazy support. So if you haven't and are enjoying the content, make sure to hit the thumbs up and the subscribe button. Finally, if you want to support the channel a little bit more, make sure to check out my special offer at fool.com/Jose. Now back to today's episode.
Now, I do believe these weaknesses do create a question for investors. The question is, does the short-term struggle hurt the long-term vision? While UiPath long-term vision includes significant investments in things like artificial intelligence and automation innovation, the immediate focus on rectifying sales execution and deals predictability might have overshadowed these strategic advancements. Investors may be concerned that the short-term execution issues could delay the realization of the long-term growth potential. So I want to talk a little bit more about maybe some of the reasons to be bullish. I have 3 reasons here to be bullish on UiPath, but I want to hear from you right now. Do these kind of headwinds that UiPath kind of saw, are they enough to overshadow the long-term growth, at least for now? Now I want to talk a little bit about 3 reasons to remain bullish here in UiPath. First is just product innovation and AI integration. So UiPath continues to invest heavily in AI and automation technologies, and the company introduced several new innovations, including Autopilot, which is a suite of tools that leverage generative AI to automate complex business process and is set for general availability in June. And they mentioned that Autopilot has already attracted significant interest from industries such as technology, automotive, pharmaceutical, and advertisements. Now, they're also specializing in things like large language models like everybody else. New models like DocPath and CompPath combine generative AI with automation to enhance business process efficiency. And these models are designed to understand and process a wide range of documents and message, significantly outperforming existing solutions in terms of accuracy and applicability. Now, the third thing that they really talked about was their context grounding, which is a new feature within their UiPath AI trust layer, which improves the accuracy of generative AI models by extracting information from company-specific data sets. So obviously, right now, we are seeing kind of this huge push in investments of AI from big enterprises, and UiPath definitely has that ability with automation to link everything together as well. So they definitely, on the top level overview, have some great reasons to be bullish. But I do have a question at the end of this episode that might make you rethink some of the bullishness for this company. So the second reason to be bullish, right? The first was kind of just the innovation in the AI space right now. The second is the partner ecosystem and strategic relationships. Some of the strategic relationships for a company like these are crucial to their go-to-market strategies. One of my favorite ones was they expanded partnership with Microsoft and highlighted by the integration with Microsoft Copilot for 365, which enables customers to automate end-to-end business process, enhancing user experience with UiPath's automation capabilities. So obviously, partnerships like this can continue to help this company grow at crazy levels, especially since Microsoft and some of the other partnerships that they have are really focusing in the AI space. Now, the third reason to be bullish, in my opinion, is just their overall strong balance sheet that this company has. 1.9 billion in quick cash, which is cash equivalents, and current marketable securities, and no long-term debt. And at the same time, they're still positive in cash flow from operations. So definitely a very, very strong balance sheet. Now, we took reasons to be bearish, we took reasons to be bullish. I believe the final question as an investor here is, does artificial intelligence make this company's moat stronger or weaker? And the reason I say this is I do believe for a lot of industries, artificial intelligence and a lot of companies, artificial intelligence has made some of the companies' moats weaker. But there's obviously others that have gotten stronger from it. Obviously, on a top level overview, their automation skills put together with AI can create some amazing solutions, but is now the AI capabilities, does it make it a lot easier for competitors to enter this space? So I hope you guys enjoyed today's episode. Let me know what you guys think. Take care, have a good day, and see you all next time.